The Monetary Policy Committee of Nigeria's central bank is due to hold its first meeting since its $2.6 billion bailout of 5 banks and sacking of the institution's senior executives. The MPC is largely being expected to keep interest rates unchanged at 6%. But to share his views and some of his expectations, Jude Fejokwu, CEO of Thaddeus Investment Advisory, joins me now live from our studios in Lagos. Thanks so much, Jude, for joining us this afternoon. Well, are your expectations of this afternoon's MPC meeting in line with consensus? Are we looking at rates being held steady in your books?
We expect them to be held steady, and we can see why, but we disagree. We believe the rate should be dropped down to 5%, dropped by 100 basis points. And this is why. First of all, before the CBN guaranteed interbank lending, the one-year interbank rate was about 22%. Now it's about 16% as of last Thursday. So, in other words, it's not really had the desired effect in our books. While we understand that one rate cannot do all the work, but we think we can still come down further, especially given that the definition of the rate has been changed to now mean 2% below the repo rate. So we think it should go down to 5%.
Compounding the problem, of course, has been the entire scenario within the banking arena that could force interbank rates themselves to climb as banks become reluctant to actually lend to their peers. And so the central bank may well find its pressure to actually cut rates to ease liquidity back into the system, couldn't they?
Yes, we totally agree with that. It's interesting to note that despite the bank's guarantee, the banks still don't trust themselves. Well, in a way, it makes sense. Even if secondary body is going to back up your loans, you still don't want the person, your counterparty, to default. So you'll still be cautious in lending. That's what we have here. So that's true. While the CBN works hard to set things straight, they should bear in mind about the hidden monster called inflation.
Yep,
and that's lurking in the back.
Let's take a look at that, because the banking sector and banking issues aside, there is this broader economic picture to look at. Has the central bank actually taken its eye off inflation for now?
As far as we're concerned, yes. Given actions and given words at the beginning, we believe it's secondary now. The banking crisis and growing the economy, supplying liquidity to the economy appear to be uppermost on their minds. But let them bear in mind that it's taking some actions that have set them back. First of all, they said that the banks can now buy and sell foreign exchange between themselves, which was before not allowed. After 2 weeks, the dollar appreciated against the naira by 6%, and they now reversed themselves and stopped that. So now we're an import-dependent economy, and people are buying things more at higher prices, importing things. And who gets the brunt of it? In most cases, the consumer. And that leads to higher inflation. So definitely, it's a vicious cycle we have here. Very
quickly, Jude, implications for growth in the 2009 period?
We think, as expected, the government is a little bit ambitious. While there's hope, as always, reality on the ground does not point to a 5% growth for this year. We're looking at about 3.8%, 3.8 to 4% maximum. Remember that we just had that the revenue for the government declined by 21% quarter by quarter. So the money is not even meeting budget estimates, and that's going to have an impact. So I don't see how it can have 5%. We're at 3.8%. Non-oil receipts were at about 4.5%.